So if you are living in Switzerland and thinking about investing this year, you are probably overwhelmed. Too many platforms, too many ETFs and stocks, and everyone online says, just buy this or just follow that. But here's the truth. Most beginners don't fail because they pick the wrong ETF. They fail because they skip two very critical foundations. And today I will show you exactly what I would do if I just wanted to start investing this year. And then I will walk you through my simple investment system that helped me build my first million in my early 30s in Switzerland. Hi, it's Charlene, and this is the channel where I share my over 10 years banking and investing experience with you all for free. Like and subscribe for more. Many investment coaches or online gurus that will tell you probably investing is for everyone. Is that true? Yes and no. And let me be very, very honest with you. As an investment coach or a financial advisor, of course I would say, investing is for everyone. You pay me, you buy my course, or you pay me by hours and everyone is happy. But that's not responsible. So because investing is actually not for everyone yet. And there are two things you must clear first. So if you haven't cleared one of them, pause investing. Fix these first. And the first thing is about high interest rate debt. I'm not talking about your mortgage. I'm not talking about a normal car loan. I'm actually talking about high interest rate debt, credit card debt, personal loans, and anything charging you 6%, 7% or more. And that kind of debt actually quietly drains you. And I see this mistake all the time. And people feel desperate and they want a quick fix and they look at, for example, investing as the cure, as the medicine. That is very, very dangerous because no investment can guarantee you 5 to 7% per year. Yes, the global stock market averaged around 8 to 10% over the past decade in USD terms. But what people don't see is actually the volatility. So some years are down, some years are flat, some years are painful. So if you need your investment to pay back your debt, you will panic at the worst moment. So let me be very clear. Never rely on investing to fix high interest rate debt. It is not sexy, so pay back your high interest rate debt first before you start investing. And the second thing I really want you to clear is an emergency fund. And this is about risk management. So not returns, not performance, just protection. And ask yourself, what if, for example, you lose your job? What if you break your arm? Touch wood. What if something just happened to you or your family? Life happens, right? An emergency fund gives you really breathing room. And globally, people say 3 to 6 months of your expenses in a savings account as your emergency fund. For example, in the US, people say, oh, put it in a high yield savings account. But in Switzerland, we don't have such thing, high yield. The yields or the interest are super low here, but it doesn't matter at all. You just need to put the money into your savings account. However, context also matters. In Switzerland, I understand most people feel more secure, right? So if you lose your job, we have RAF. RAF exists. So if you break your arm, health insurance covers a lot. For some people here, I would say 1 to 3 months of your expenses can already be reasonable. And in some other countries, for example, the US or part of Asia, 3 to 6 months may be necessary. So there's no perfect number. But the goal is very simple. The emergency fund really gives you a peace of mind. So no forced selling of your investment if something happens to you. So once you check high interest rate debt and a basic emergency fund, then yes, you are ready to invest, even if your income isn't perfect, even if you're just starting. And now we can talk about investment strategy, and that is where investing actually becomes powerful. And a lot of people in Switzerland, especially expats, experience the same thing, I believe. So we move here, our salary jumps compared to our home country. And then you think, oh, I earn so much more now. I don't need to worry about money at all. But then inflation hits And you've seen it, for example, in the news over the past few years. And what does inflation actually mean? So let's keep it simple. So today, for example, you buy a nice box of Swiss chocolates. It costs you 100 Swiss francs. Yeah, very nice one. Okay, very nice. One box from Lederach, for example. And next year, the same box costs you 105 Swiss francs. So same chocolate, same box, okay? The extra 5%, that is inflation. Now you can zoom out. Basically, inflation means your money slowly buys less. Let's say if you earn 100,000 per year, if inflation is 5%, but your salary only grows 2%, on paper, you are fine. But in reality, you are losing purchasing power. And here's the part most people miss. So inflation compounds. Let's assume 6% average inflation, which actually reflects the recent global trends. And most of us, I believe, we live globally, right? Not just like in Switzerland, 365 days per year. So what happens to your 100,000 in cash? So for example, year one, 6% is gone, which is 94,000 left. And then out of this 94,000, year two, another 6% is gone, which is around 88,000. And again, another 6% of this 88,000 will be gone in year three, which you will only have 83,000. And you continue do this mathematics, then you in year four you have 78,000, in year five 73, and you continue to do this mathematics. Let me just show you the year 10 number is only around 54,000. So in just 10 years, almost half of your purchasing power is gone. So if you have 1 million sitting in cash, in 10 years, that's about only 500K left, which is half is gone. You didn't spend it and you didn't lose it, it's just quietly disappearing. And that's why investing matters, not to get rich fast, but to protect your purchasing power. And here's another risk. So for most people, the job market or the job actually makes up 70, 80, or sometimes 100% of a person's total income. That is very dangerous. If you look at the news, the finance firm, the technology companies, consulting firms, layoffs are everywhere. And in Switzerland specifically, labor is very expensive here. So for example, if a company can move work to India, the Philippines, Eastern Europe, or even in the United States, they often will, not because you are bad, but because costs matter. So unless your role must be local, like sales, client-facing, communication, so ask yourself honestly, do I feel 100% safe depending on one employer for over the next 20 to 30 years? And for most people, the answer is no. And that's why investing matters. It creates another pillar, another income source, and another buffer. And now let's talk about investment strategy. Like I mentioned earlier, once you've cleared high interest rate debt and the basic emergency fund, and you understand why you need to invest, you are ready to invest. It doesn't really matter if your income is not perfect or irregular. It doesn't really matter if you're just starting with a few hundred or sitting on a few 100,000 or a few million francs in cash, not knowing what to do. So now let me guide you step by step. And this framework and strategy I use myself and also teach inside my Vision Investment Academy. And I also touch it a little bit in some of my other videos. But here I wanted to walk you through it in some more details. So step number one, define what you want your money to do. So this is actually the most important step and the most skipped one. Online, people love to say, just buy this ETF, just buy that stocks or hold it for 20-something years. That's not a strategy. That is noise. And let me ask you a question. Should the 30-year-old woman who moved to Switzerland a few years ago, earns well, saves consistently, and want to retire early and start her own business one day, like this profile, do you think she should invest the same way as a 35-year-old man who wants to buy a property in Switzerland in 7 years? And should they invest the same way as a 55-year-old woman planning her retirement? And should they invest the same compared with a family with a 10-year-old kid saving for the kid's future education? So of course not. So different lives, different timelines, different investment goals. So before you ask anyone, oh, this year, what should I invest? You must be clear. What is this money for? When do I need it? And what do I want it to enable in my life? And that's the step number one. Set realistic goals. And everyone said, I want to get rich. My goal is to get rich. Sure, but what does it mean? How much, right? And by when? And with what kind of risk? So you cannot have everything. And just in life, you cannot realistically expect a guy who is super rich, who is super handsome, with six-pack abs and available to you 24/7, right? It's feeling and treating you like a princess forever. So investment goals work the same way. You cannot say, I want an investment that can double return overnight without any risk. So your investment goals must be specific and realistic. So for example, do you want to save for a property down payment, let's say in 5 years? And do you want early retirement from corporate jobs and have your own business in 15 years? Or you want to support your kid for further education in university? So you need to be specific and realistic with the amount of money you need and the timeline. Otherwise, you're either chasing fantasies or give up too early. Step number 2, understand different investment options beyond just a few stocks and ETFs. And this is where many beginners get stuck. They know one or two things. Maybe a few stocks like Apple or Amazon or Google, Microsoft, maybe some ETFs like S&P 500, and maybe they heard about cryptocurrency like Bitcoin. But investing is much, much broader than that. So we have, for example, stocks. We have US stock, European stock, Asian stock, emerging market stock, growth stocks, value stocks, dividend stocks, for example. And within bond, we have government bond, we have corporate bond, we have short duration bond, we have long duration bond. And within alternatives, we have real estate, we have REITs, real estate investment funds, and we have infrastructure, we have private equity, we have cryptocurrency. And instruments, we have ETFs, we have mutual funds, we have index funds. I'm not saying, my friend, you need to invest in everything, but you really need a holistic view. You should understand the pros and cons of each option and how they work and how they fit your short-term, mid-term, and long-term goals. Even if you only have 5,000, 10,000, 50,000, you still have options and you still should have this holistic overview. You definitely have more options than you think. Step number 3, build your investment strategy. And now everything comes together. You understand step number 1, right? Your financial situation and your short-term, mid-term, long-term goal. And you have your investment options, the pros and cons for each of them that I just mentioned in step number 2. So only now do you build your investment strategy. So not random, not emotional, not copying others. Instead, a strategy designed for you. For example, based on person A's timeline and situation. And probably it will make sense if this person has 40% of the portfolio in US and 20% in Europe stocks and 10% in Asian stocks, 5% in Bitcoin, and the remaining in a diversified bond fund. And this strategy may work perfectly for person A, but might be very, very risky for person B. And some of my friends, they often ask me, oh, Charlene, you have a portfolio that now is over 1 million and you started with over 500. Can you share with me your investment portfolio and your strategy? And then I will just copy. I mean, yes, I can show you my portfolio, but don't just take and follow me. Why? Because my investment goals and my own situation could be totally, completely different from you. So design a strategy that fits you and your financial situation and goals. Then it gets easier and easier. Step number 4, execute it. And number 5, optimize. And then, you execute, you slowly, steadily, consistently manage the risks. And over time, you optimize your own portfolio. And you optimize across taxes and fees, and your allocation as your investment goals may change over time. And now I wanted to share really the big mistake people make is to really skip step number 1 and 2 that I just mentioned. They don't know their own financial situation. They're not clear about their short-term, mid-term, long-term goals, and they don't understand they have so many investment options in front of them, and they don't have this kind of overview, holistic picture. They just jump straight to what is the best investment. So there's only the best investment for you, and that is the difference between guessing and investing. And once you get this right, everything becomes much, much more clear and calmer. So if this framework resonates with you, my friend, actually I've put together a free investment training where I go much deeper into this with real examples and model portfolios. For example, we also offer a course for those who want to go even further. But my honest advice is simple, so start with the free training first to see if it resonates, and then you can decide later. So you can sign up using the link in the video description area. Spots are really limited. I will see you inside the free investment training.